You're welcome to another day at the Binary Options University. And today we're going to continue from where we stopped the other day. Okay, we're going to continue from where we stopped yesterday. Okay, so we talked extensively and we practiced using different formations, different currency pairs. Okay, so we're going to continue today, and just to show you that the Amster pattern strategy works for all time frames. Okay, so today we're going to be looking at the 15 minutes again. Okay, because the 15 minutes is not too fast and it's not too slow. So it's we've discovered that the 15 minutes is like the middle ground for most of our students. 15 minutes is that time frame that most people engage. Okay, so most of our students they trade a 15-minute candlestick chart. Okay, so that's the reason why we decided to teach you guys, to show you guys the 15 minutes candlestick chart twice. Okay, so we had one yesterday, so we're having another one today as a continuation, just to further buttress our resolve and to further emphasize the principles. Okay, so a sound mastery of these principles will place you ahead of other traders. Okay, so you're gonna enter at the best time, and you're gonna exit at the best time. Okay, what I mean by that is this: you're gonna be entering your trade at the best time, and then you're going to select an expiration time that will lead to 90% wins most of the time. Okay, so meaning you're going to be winning 90% out of 90 out of 100 times. Okay, that's 90%. Okay, so I hope you guys have been going through previous charts, and you've been studying the patterns and studying the charts, because I always emphasize this. Patterns will always repeat themselves. Okay, so a sound mastery of the Amster pattern through previous history charts, you're going to position yourself as an authority. Okay, so a sound mastery of the Amster pattern through the history of the charts. Okay, what I mean by that is you go through the charts, you try to check the past and compare with the future. You check the past, the formations in the past, you go into the history of the chart. Okay, you go deep down, you go into 2017, you go into 2018, you go into 2019, then you check 2020, and you just keep checking and checking and checking, okay, to ensure that you are able to get this thing into your subconscious. The moment it gets your subconscious, you are able to identify as soon as the pattern forms. You are able to identify and take opportunity immediately. Okay, so you have to go, you have to do a lot of studying, a lot of research, a lot of browsing through the history, okay, of a particular currency pair, so you get more familiar with the pair. Okay, so every asset has a behavior. Okay, so the more you master the behavior of an asset, the better you are at identifying formations. Okay, so the more you master the behavior of an asset, the better you are at identifying the formation or a pattern. Okay, so and then you get to familiarize yourself with the times when the asset doesn't produce the best results. Okay, so as you trade a particular asset, you become more familiar, and then you become more profitable on that asset. Okay, so today we're going to continue with the 15 minutes chart, and we're going to be using the same setup. Okay, so we're like I told you, you must set your Bollinger Band. Okay, the Bollinger Band is a volatility indicator, and it's also a trend indicator. Okay, so um, instead of setting too many indicators, is it not better to set an indicator that doubles as a trend and volatility indicator? So the Bollinger Band serves the two functions. Okay, it doubles as a volatility and a trend indicator. Okay, so that's why we always advise our students, we recommend that they have the Bollinger Band. Okay, but because the Bollinger Band is composed of the 14-day moving average. Okay, that's the middle line. And also we have the +2 and -2 deviation of the 14-day moving average. Okay, so the first thing to do is to go to the indicators icon, and click on it to bring out the list of indicators. Okay, and so when you get to the indicators, you select Bollinger Band. It's among the favorites. Okay, so you select the Bollinger Band. That is the first thing you should set on your candlestick chart. And also, before you might not see the candlestick chart, you must set the chart to candlestick. Okay, so it's usually the default setting of most brokers is the line chart. Okay, so the first thing you need to do is to change. You need to change the line chart to a candlestick chart. Okay, and so the next thing after doing that, you need to go to your indicator list and select the Bollinger Band. Okay, so when you select the Bollinger Band, the next thing you need to do is to select the RSI, the Relative Strength Index. Once you select the Relative Strength Index, it comes up like this, like a graph, like a chart with a line graph in between. Okay, so the RSI is basically a Relative Strength Index. It's an indicator that informs us about the change in momentum. Okay, so when there's a change in momentum, the RSI will indicate it by a change in transition. Okay, so the transition will either go up or down. When you see a transition going down, it's indicating a shift from a trending position to a weakened trend. Okay, so the RSI is a very good indicator. So we've discussed this in the previous lessons. So I'm just trying to bring it back to our memory. Okay, so this is how you're going to see it, and this is the perfect setup. Okay, so the next thing you are looking for price to range to trend in a very strong way. You want the momentum to be very strong. Okay, so that indicates that there is strong buying pressure. Okay, so what you're looking for is a period of strong buying or selling pressure in a downtrend. Okay, so in an uptrend, you are looking for a very strong buying pressure. Okay, so and then you want the momentum also to be very, very strong. So the Relative Strength Index is an indicator that tells you and informs you about the change, the rate of change of momentum in a particular market or in a particular asset. Okay, so when you see an asset making a higher high on the Relative Strength Index, it's only telling you that the momentum is going higher and there are more buyers interested in buying that particular asset. Okay, so but when you see a lower low, a lower high in an uptrend, it indicates that there will soon be a shift in bullish momentum. Okay, so the next thing you need to do, you have to look for an asset that has a very strong bullish or bearish momentum. Okay, so and this is confirmed by a cross out of the Bollinger Band. Okay, so the moment you see a cross out of the Bollinger Band, that confirms a bullish or bearish trend. Okay, so this particular chart, you can see that there is a very strong move out of the Bollinger Band as seen by this Marubozu candle. Okay, so this Marubozu candle is the confirmation that the buyers are fully in control. Okay, so the next thing you need to do, you have to confirm that this particular movement is a real movement by checking the RSI to confirm the strength of the particular trend. Okay, so if you're seeing a bullish candle or a Marubozu that looks very, very big, it tells you that the volume is very high and there are a lot of people interested in that particular asset. Okay, so the next thing you need to do is to confirm that whether the particular move is a real move. So the way of confirming is by checking the RSI to see the particular position of the RSI graph. Okay, so if the graph crosses the 70 level, you can see that it is actually a true move. It's not a false move. Okay, so but there are times when the RSI line or the graph does not cross the 70 overbought level. Those periods are periods when the market is experiencing what we call a false volatility. Okay, so and those are times when the market will crash down. Okay, so what you're looking for times when the market crosses the Bollinger Band and also crosses the 70 overbought level on the RSI. As soon as that is confirmed, you can say the asset is trending and is strong. Okay, so the next thing you want to do is that you want the asset, you want the price. If you can remember what we discussed the other day, we discussed the pair of jeans concept, and that is a way of knowing the levels that are difficult for price to, the levels that make it difficult for price to rise. Okay, so at a certain level, the buyers stop buying. Okay, and that level is called the resistance line because the buyers find the price very not competitive enough. Okay, so the buyers don't want to buy because they feel that asset is overpriced. Okay, so what really happens is that when you get to a resistance point or a level where the market, the buyers are seeing the asset as being overpriced, there's something that will happen. The vendors or the players in the market, the vendors are selling that particular asset. For in this case, we call it the pair of jeans. Okay, so the vendors selling the pair of jeans will reduce the price of the pair of jeans so that the price can be attractive enough for buyers. Okay, so the moment they reduce the price of the pair of jeans, you can see the price fell down. And as soon as the price fell down here, you can see the price became very attractive for buyers. Okay, so it gets to a level whereby the people, the buyers, consider a particular asset as being good, and they consider the particular asset as being well priced. Okay, so but at a certain level, no matter how good the commodity is, no matter how good the asset is, at a certain level, people become less receptive to buying. Okay, so they become more skeptical about buying because they feel that asset is overpriced. Okay, so at that level, no matter how good the asset is, people will either hold their money or they will stop buying. Okay, so you have to understand this, that this controls every market. Okay, so at a particular price, when an asset is considered overpriced by the majority of people, okay, the price will crash because there are very few buyers for that particular commodity or asset. Okay, so when the asset is overpriced, there will be a reaction from the market, and the market will give you a feedback that the particular asset is overpriced. And so the next thing that will happen is that the market will adjust itself and the price of the commodity or asset will drop. Okay, so at that point we call it the resistance level. That is the level where the buyers have stopped buying. That's the level where the buyers said, no, we are not going to buy again. Okay, so at that level, you call it the resistance level. Okay, so that resistance level would lead to a drop in price. Okay, so at the level where people pick interest in that particular asset, that level is called the support level. Okay, so at that level, the buyers pick interest in that particular asset and they started buying. Okay, so at that point, you can see it that this level, buyers became interested in a particular asset, and you can see the price of the asset that made a continuous movement upward. Okay, so that is a trend continuation. Okay, so you can see. So what you're looking for, by the way, this is the Australian dollars, the Australian dollar USD, US dollar. Okay, so you are looking for a time when the price crosses the Bollinger Band and then also crosses the RSI, and then you're waiting for a retracement back into the Bollinger Band, and then you want the price to continue in its previous trend. I call it a trend continuation. Okay, so and then you want the price to break the previous resistance level. Okay, so from the look of things, this is a very close shave. Okay, so I don't recommend that you trade this particular setup, because as you can see, the cross above the previous resistance level was not a clear cross. You can see it. The cross of the previous resistance level was not a clear cross. And because it wasn't a clear cross, it becomes risky. Okay? So it's simply telling us that there is no cross yet. And so the market can continue ranging without going down or up. Okay, so you have to wait for a cross. You have to wait for a cross of the resistance level. Okay, so when the market crosses the resistance level, then you can wait for a retracement or a confirmation candle to form. Okay, so you can see in this case the confirmation candle formed over here, and then you wait for a retracement back to the level, to the upper body of the confirmation candle, and that is your entry point. And so your expiration time is a whole 15 minutes, not less than 15 minutes. Okay, 15 minutes or more. Okay, but not less than 15 minutes. Okay, so it can be 15 minutes, it can be 20 minutes, depending on the time at which your confirmation candle formed. Okay, so let's move on. But this is not a good setup, because the price did not cross clearly. The price did not cross clearly. You can see that the resistance line is somewhere around here, and you can see the cross is not significant. Okay, so you don't trade when the cross is not significant. Okay, let's move on. So the next one we're going to talk about is the AUD USD. Then the next one, the next one, the first one was AUD USD. The next one is also AUD USD. Okay, so you can see, you can clearly see that this one also, okay, the cross was not clear. Okay, so whenever the cross is not clear, it's not advisable to trade it. Okay, so this is for you to know that this is not a good setup. Okay, so the price must always cross the previous resistance level. Okay, so let's move on. Okay, so this is an excellent setup. Okay, so like I said the prices, the charts that are very good to trade, AUD USD, AUD JPY, CAD JPY, USD CAD, Euro USD, Euro Great British Pounds. Basically, those are the good pairs that have good volatility and good formation. Okay, so those are charts that you can predict their movement. Okay, don't trade the New Zealand US dollar, the NZD USD. Never trade it. It has very choppy formations. Okay, so don't trade the New Zealand USD. Don't trade the US dollar CHF. US dollar CHF is also a chart that has a choppy formation. Okay, so the Euro Great British Pounds will range more than it trends. Okay, so Euro Great British Pounds is more of a ranging market. Okay, so but our most favorite is the AUD USD. Okay, so the AUD USD is a very good pair to trade. Okay, so AUD JPY is also very good. CAD JPY, USD CAD, Euro USD, Euro Great British Pounds, USD CAD. Those are very good pairs. Okay, so let's move on. So the first thing you want to look out for is for a strong bullish or bearish momentum. Okay, so you're looking for a strong bullish or bearish momentum. Okay, so from the chart you can see that the Australian dollar US dollar, there was a bullish move up here. Okay, so when there's a bullish move up, you want to wait for a retracement back into the Bollinger Band. Okay, so there is a move up as a cross out of the Bollinger Band, and then you want a retracement back into the Bollinger Band. Okay, so when there's a retracement back into the Bollinger Band, you want the price to continue trending inside the Bollinger Band again. Okay, the price must not cross the Bollinger Band again. Okay, so the price should fall within the Bollinger Band the second time. So the first move up, a cutback or a retracement, trend continuation, then the trend must continue inside the Bollinger Band and must cross the previous resistance level. Remember the pair of jeans. Always remember that. Okay, so the price must cross the resistance line. Okay, so as soon as price crosses the resistance line, you want to confirm that the move is a solid move. You want to confirm that the momentum is actually a bullish momentum. You want to confirm that the momentum is actually very strong. Okay, so the way of confirming the strength of the move or the trend is by going to the relative strength index to check whether there's a cross above the 70 level. Okay, so when there's a cross above the 70 level, you can be rest assured that that particular asset has a very strong momentum. Okay, so you don't want to trade an asset that doesn't have a strong momentum. Okay, you want to trade an asset that has a strong momentum than weak momentum. Okay, so whenever you see a strong momentum, then a weak momentum, it is indicative of a reversal or a retracement. Okay, so you want the price to first show signs of strength, then show signs of weakness, then form a reversal candlestick. Okay, so the first sign of strength is a close outside the Bollinger Band. Okay, and this is confirmed by the close outside the relative strength index. Okay, so when the price crosses out of the Bollinger Band and then you see a corresponding cross out of the as soon as that forms, as soon as you see the formation that way, and then you see the move out of the Bollinger Band and you see a retracement, then you see a continuation, then the next thing you want to look out for is you have to make sure that the confirmation candle forms. Okay, so you can see the reason why this particular confirmation candle failed, because the cross above the previous resistance level wasn't so clear. Okay, so you want the cross to be very significant. Okay, so you want the cross to be significant enough for you to place the trade. Okay, so you have to wait for a cross, and the cross must be significant. The cross of the resistance level must be significant for enough before you trade. Okay, so you can see the cross at this level. You can see from this level to this level, you can see it's significant. There is a clear, significant cross. Can you see this? It's a clear, significant cross. Okay, so you want to make sure that the cross is significant enough before you trade the confirmation, because you can see the reason why this particular confirmation candle failed was because the resistance line was not crossed significantly. Okay, so you want to make sure that there's a significant cross of the resistance level. Okay, and then the next thing you want to look out for is you want a confirmation candle, a Marubozu or a star or a shooting star. Okay, as soon as you see a confirmation candle, the next thing you want to look out for is the retracement back to the upper body of the confirmation candle. Okay, so when you see a retracement back to the upper body of the confirmation candle, that's a trade. Then you place the trade 15 minutes, a full 15 minutes. Okay, not less than 15 minutes. Okay, not 14.56, not 14.55. Okay, so you trade 15 minutes or more, 15 minutes plus or 15 minutes. Okay, so you're basically you trade the next expiry, the next 15 minutes expiry. Okay, so let's move on. The AUD USD. Okay, the AUD USD. So the AUD USD is a wonderful chart, and like I mentioned, it is amazing. Okay, so what you're looking for is the same thing. You want a cut out of the Bollinger Band, then a retracement, then you want a continuation, then you want a confirmation. You can see this star, the star confirmation, and you can see clearly there's a clear cross of the previous support level. Okay, because when it's down is a support level. When it's up, you want a cross of the resistance. But when it's in a downtrend, you want a cross of the support level. So you can see this is a support level and there's a clear cross. You see there's a clear cross of this support level over here. There's a clear cross of the support level. Okay, so that is what you're looking for. So the next thing you're looking for is the confirmation. As soon as you see the confirmation candle, the color green, okay, so you wait for a retracement back to the lower body of the confirmation candle, and then you trade 15 minutes. Okay, so let's move on. Okay, so this is the AUD USD also. The AUD USD also. I think this is the fifth chart today. Okay, so this is the fifth chart today. This AUD USD also. Okay, so what you want, right, is for the price to close out of the Bollinger Band. Then you want a retracement back into the Bollinger Band. Okay, then you want a continuation inside the Bollinger Band. Okay, so in this case, you can see that there's a cut back, there's a retracement back into the Bollinger Band, but price tried to push up again. Okay, so but something happened again. There's another retracement back into the Bollinger Band, then price went up again. So at this point, you can see the wick forming up in the direction of the trend. So whenever you see a wick form in the direction of a trend, is a sign of rejection of the price. Okay, so when you see a rejection, is a very good sign of a reversal. Okay, so the next thing you want to look out for is the formation of a confirmation candle next to this candle. Okay, so this is a signal candle and this is a confirmation candle. So the confirmation candle must be a star or shooting star or a Marubozu. Okay, so you can see that this confirmation candle is like a small Marubozu with a little wick on top. Okay, so as soon as this form, the next thing you want to wait for is a retracement or a cutback and a touch of the upper body of the confirmation candle. Okay, so as soon as price goes back and touches the upper body of the confirmation candle, you place a trade. Okay, so you place a trade in the opposite direction. That's a put trade. Okay, so and that you set 15 minutes, not 14.15. Okay, so let's move on. Okay, so the Euro Great British Pounds. The Euro Great British Pounds. Okay, so you can see the cross up. Okay, and then you can see the cut back inside. Then you can see the continuation that could not cross outside the Bollinger Band. Okay, by the way, this Euro Great British Pounds, it could not cross out of the Bollinger Band, and then you can see the formation of the confirmation, very nice confirmation candle. This is a very good armor. This is a very good shooting star. Sorry, a very good shooting star. Then you want to wait for a retracement back to the body, to the upper body of the confirmation candle, which is the shooting star. Okay, so as soon as price touches the upper body of the as soon as price touches the upper body level of the previous confirmation candle or the confirmation candle, you place the trade immediately in the down direction. Okay, so that's the put trade. Okay, for 15 minutes. Okay, so the next one we're going to talk about is the Euro Great British Pounds. Okay, so you can see the same thing happened here. There's a cross out of the Bollinger Band, and then there's a cut back into the Bollinger Band, and then you can see that price continued inside the Bollinger Band, and then there's a confirmation candle formed over there. So you wait for a retracement back to the upper body level of the confirmation candle. Okay, so as soon as that is confirmed, You confirm also that the RSI is obeying the divergence principle. Once it's confirmed, you place your trade. Let's move on. So the Euro Great British Pounds also. That's our 8th chart today. Okay, so you can see the price moved upwards. You can see with a very strong bullish momentum. Okay, so you can see after the bullish momentum, you can see how the price, the buyers started, they started resisting buying. Okay, so it was a temporary hesitation. Okay, so you can see that the price dipped a little. Okay, but because this particular asset is trending so much, there is no how the thing will not continue upward. But there's one thing that will happen. There will be a reduction in the strength of the trend, which is confirmed by the movement along or tagging of the band. Okay, so the price will not form outside the Bollinger Band again, but the price will form within the Bollinger Band with a tag of the upper band. Okay, when you see a tag of the upper band, it tells you that there is a resistance to upward movement. There's a resistance to the bullish trend. Okay, so it tells you that that there is a weakness in the market, and so people will soon start selling. Okay, so and once you start seeing a lot of weak in the upward direction, in direction of the trend, you know there's a rejection. There's a constant, continuous rejection, and the next thing that will happen is a crash in the price of the assets. Okay, so when you see a weak coupled with the tagging of the upper band, you can be rest assured that a reversal is around the corner. Okay, so the way you confirm a reversal is the formation of a confirmation candle. Okay, so when the confirmation candle forms, you must wait for a cut back or a retracement or a touch of the upper body of the confirmation candle. I can't overemphasize this. Okay, so you have to wait for a cut back and a touch of the upper body of the confirmation candle. So as soon as the price touches it once, immediately it touches it, you place the trade. Okay, let's move on. So this number 9, you can see clearly that there is a very choppy chart. Very choppy. Okay, it's a choppy chart. So I don't advise people to trade choppy charts. Okay, but with experience, you can trade this. Okay, so look at price went out of the Bollinger Band, and there's a retracement back into the band. And you can see there's a continuation in the Bollinger Band. Okay, and then you can see a confirmation candle. Then you want a retracement back to the upper body of the confirmation candle, and then you enter the trade. You can see the price went down. Let's move on. Okay, so the next one is the Euro Great British Pounds also. You know, like I said, the Euro Great British Pounds is an asset that is consistent. You know, it's not unpredictable. It's predictable. It's very consistent in its formations. You know, it produces similar pattern over and over again. That's why the Euro Great British Pounds is a good pair. Okay, so you don't want to trade New Zealand USD. Never trade New Zealand USD, but I won't say never, but I would recommend that you shouldn't. Okay, we recommend that you shouldn't. Okay, because the New Zealand US dollar, it has a lot of unpredictable, choppy, high volatility moves. Okay, so when the New Zealand US dollar wants to form, you can't predict when it will form a very volatile candlestick. Okay, so you want to avoid something like that. You want to avoid a pair that is not predictable. Okay, you want to trade a pair that is predictable and is predictable, and you can predict that it will form a particular kind of pattern. Okay, so this, you can see what happened here. There's a close out of the Bollinger Band, a retracement back into the band, continuation, and the formation of a very nice shooting star, this red shooting star over here. And then you see a retracement back to the upper body of the shooting star. And the next thing you see is a win. Okay, so you have to wait for retracement back to the upper body of the confirmation candle. Okay, so always wait for the retracement back to the upper body, in the case of a shooting star, to the middle level of the wick. Okay, the AUD JPY, Okay, so this is another good pair, a very good pair. Okay, so it is very predictable also, and you can predict that it's going to form in a particular way. Okay, so it's always better and safer to trade predictable charts. Okay, don't trade charts that you can't predict. Okay, so you can see the formation. It close out of the Bollinger Band, then a close back into the band, then a trend continuation. But the reason why this is not a good entry is because you can see it didn't cross the resistance level clearly. So don't trade something like this. Okay, so you can see there's a cut back, but you see the cross is not clearly defined. The cross is not significant. So you must ensure that the price crosses. The reason why you would want it to cross is that you don't want a range to form. You can see, because this did not cross, price did not cross this level, you can see the kind of candles that were forming. Okay, you see the candles are forming in a very unpredictable fashion. Okay, so you can see the candles are just forming. They don't have a structure. You can see how many dojis form here. So whenever you don't allow price to cross the resistance level, you can see this is inevitable. This will surely form. You understand? You are going to see a formation of dojis. You see a formation of ranging candles. Okay, so always wait for price to cross the previous or the resistance level or the support level if it's in a downtrend. Okay, so when you wait for price to cut back into the Bollinger Band, then you want price to continue in the trend, but you want it to continue within the Bollinger Band, not crossing the Bollinger Band. Okay, so this is a very, very good example of what I've been talking to you about. You can see that price closed outside the Bollinger Band, and then price retraced back into the Bollinger Band. Okay, and then price continued tagging along the upper Bollinger Band. Okay, without closing outside. You can see the tag of the upper Bollinger Band, and then you see the second trend continuation actually crossed the resistance level. And so as soon as it crossed the resistance level, you can see what happened next. There was a formation of a Marubozu, a confirmation candle, but you don't trade the confirmation candle immediately. you wait for a cutback, or you wait for price to touch the upper body of the confirmation candle before you place your trade. Okay, I repeat, do not trade a confirmation candle immediately. Wait for price to cut back and touch the upper body of the confirmation candle before you place your trade. Okay, so you can see clearly that there's a transition from being strong to being weak. So you see the trend cross the upper Bollinger Band, but there was a time it cut back into the Bollinger Band, and you see what happened next. There's a trend continuation, but the trend continuation is weak because the trend formed inside the Bollinger Band, and the next thing you would observe is that the confirmation candle formed inside the Bollinger Band. Okay, so as soon as that forms, you have to wait for a cutback, and you wait for a cutback, and you wait for price to cut back and touch the upper body of the confirmation candle. Okay, so as soon as price touches the upper body of the confirmation candle, you place your trade 15 minutes and a full 15 minutes. Okay, so this is another example, a very good example. The Australian dollar, the AUD JPY. This is a very good pair, very good pair. Okay, I said this. The pairs to trade are AUD USD, AUD JPY, USD CAD, CAD JPY, Euro USD, Euro Great British Pounds, Great British Pound USD. Okay, so these are the very good pairs that are very good predictable formations. Okay, and these are pairs that are not really subject to that do not produce erratic volatility. Okay, so you want to trade a currency pair that has validated, predictable patterns. Okay, so you want to trade pairs that you can say that this will happen to it, and then you can close your eyes and you say, come, it has happened. Okay, so you don't want to trade a chart that you use validated principles and yet not get the expected results due to unforeseen circumstances. Okay, so you want to put the odds in your favor by selecting charts that you've validated and validated to produce your desired outcome. Okay, so AUD, I repeat, AUD USD, AUD JPY, CAD JPY, USD CAD, Great British Pound USD, Euro USD, Euro Great British Pounds. Those are the pairs that are very okay. Okay, so you want to wait for price to cross the upper Bollinger Band. Okay, so you want to wait for price to cross the upper Bollinger Band, and then you want a cut back, a retracement back into the band. Okay, and so the next thing you want is for price to continue inside the band. Okay, so you can see clearly there is a cut out of the band. Okay, and then price retrace into the inside the band, then the price continued upward. Then you can see the formation of the confirmation candle over here. Okay, so and then after forming the confirmation candle, you don't trade immediately. You wait for a cut back. You wait for a cut back to the upper body of the confirmation candle. Okay, so this is the last but not the least. Okay, so and this is actually the best formation for today. So you can see what happened clearly. You can see what happened clearly. Okay, so price got out of the band, Okay, price got out of the band here. Okay, you can see there's a very strong bullish momentum. Okay, so you see a very strong bullish momentum over here, and then you can confirm it on the RSI that is truly a strong move. It's not a false move. Whenever you see price cross over and cross out of the Bollinger Band, and you don't see price cross the 70 level, okay, when you don't see that happen, you know it's a false move. Okay, but this is not a false move. This is a real move, and because price cut out of the Bollinger Band and also crossed the RSI overbought level. Okay, so what you want to wait for is that you want price to retrace back into the band. Okay, so you want price to retrace back into the band. Okay, then you want price to continue inside the band but not cross the band. But from what you can see on the chart, you can see price still crossed here. So you can see it's invalid. But then you have to wait again. You don't give up. You have to wait again. Should in case the price crosses again without crossing the Bollinger Band. I repeat, you want to wait whether the price will cross this, when this one has now become the higher high, now this level. So you want price to cross this higher high, this level. You want price to go and form a second higher high. Okay, so the first higher high failed the pattern because it did not conform to the Bollinger Band rule. The Bollinger Band rule states that the second trend continuation must not cross the band. Okay, must form within the band. Okay, the first cross of the Bollinger Band must cross, and then you must see it cross the Bollinger Band. Okay, so that's the first rule. The price must cross the upper Bollinger Band clearly, and then you must see the second one is the price must tag into, must retrace, must cut into, must cut back into, must retrace into. Those are the same words. Okay, so when you use the word retracement, it's the same thing as cut back. Okay, so when price cuts back into the Bollinger Band, you want price to cut back into the Bollinger Band and then form a trend continuation inside, I repeat, inside the Bollinger Band. Okay, and you want the price to cross the resistance level over here. Okay, so as soon as price crosses the resistance level, the next thing you want to wait for is that you want to wait for a confirmation candle, either a Marubozu or a shooting star or a star, any one of these confirmation candles. Then the next thing you want to wait for is that you want to wait for price to retrace and touch the upper body of the confirmation candle. Okay, so that's basically it. Okay, you can see that the first one failed, but most times it will form a second one. So you can see this is a second trend continuation. As soon as this crossed the previous resistance level, a new high was formed, and so that's what we now call it a higher high, because this high is higher than this high here. Okay, so when we say a higher high, it means that price has moved higher than the previous resistance level. Okay, so when we say a market is experiencing a higher high, it means that price has gone up above, away from the previous resistance, to form a new resistance level, to form a new high. Okay, so you can see price formed a higher high. Okay, so the next thing you want to wait for is a confirmation candle. So when the confirmation candle formed, you can see it clearly. You do not trade immediately after the price closes. Okay, so you have to wait for a retracement. You have to wait for price to cut back and touch the upper body of the confirmation candle. Okay, so you want price to cut back and touch the upper body of the confirmation candle. As soon as price goes back and touches the upper body of the confirmation candle, you'll be rest assured that it's going to end in a win. Okay, 90% of the time. Okay, so it's 90% accurate. Okay, so you place an expiration time of 15 minutes. Okay, so you can see it, and then you have to make sure that the price agrees, the RSI obeys the divergence. And you know what the divergence is? The divergence is when the higher high on the candlestick chart in an uptrend is producing a lower high on the candlestick on the relative strength index. Okay, so I repeat, a divergence is when the higher high on the candlestick chart is producing a lower high on the relative strength index. I'll say it one more time. A divergence is when the higher high on a candlestick chart is producing a lower high on the RSI chart. Okay, so you can see clearly that the high here, this is the lower high and this is the higher high. So the higher high over here, if you trace it down to touch the RSI, you can see that level is lower than this level than this lower high over here. So this is a lower high on the chart. So you trace it down. And then you can see clearly that this level is higher than this level over here. So once that happens, and then you can see that the higher high is not producing a higher high on the RSI, it means that there is a shift in the market sentiment. There's a shift in the momentum from the bulls to the bears. Okay, so it indicates that there is a shift in momentum from the bulls to the bears. Okay, so another thing you want to ensure is that you have to ensure that there is no news release within the expiration time of your trade. You want to ensure that there is no news release within the expiration time of your trade. And also make sure that before you enter a trade, confirm that there's no news release within your trading period. Ensure that there is no news release 5 minutes before you enter the trade, and then 5 minutes before 5 minutes after the expiration of your trade. I repeat, before you enter a trade, ensure that there is no news release. When I mean no news release, there is no high impact news release. You will see it on the Forex Factory as a red colored news release. Okay, so on the Forex Factory, you have the orange colored news release, you have the yellow colored news release, and you have the red colored news release. So these are color coded news releases, okay, that help traders to stay on guard. Okay, so they are color coded. Okay, so when you see a red on the Forex Factory, it's an indication of a high impact news that will be released. Okay, so when you see a yellow coded news release, you should know that it's a low impact. Okay, so when you see an orange coded news release, you know that it's a medium level impact. Okay, so you are to avoid high impact news release. That is the red coded. Okay, so any news that is coded red is high impact news. So you want to avoid those new release. Okay, so you have to ensure that your trade is before you enter the trade, there is no news release. Okay, that will affect your expiration time. Meaning, the news release should be at least 5 minutes away from the expiration time. What I mean by that is the expiration time should be 5 minutes. The news release should be 5 minutes away from your expiration time. Okay. So I believe we've covered a lot today. We're going to continue tomorrow. We continue tomorrow with the 30 minutes. Okay, I just want to show you guys that it cuts across every time frame. Okay, so it works for every time frame. So you just decide on your risk tolerance level. Okay, so those who are risk averse, they trade a longer time frames. Okay, so individuals who are risk tolerant, they trade the lower time frames. Okay, so the lower the time frame, the higher the profitability, the higher the profit potential, and the higher the risk. The higher the expiration time for longer time frames, the lower the risk, the lower the profit potential. Okay, so you have to decide whether you are a risk averse person or you are a risk tolerant person. Okay, so I believe we've covered a lot today. So we'll continue tomorrow, and see you guys. Thank you for joining. Bye.